this webinar is we're going to talk about venture capital, and is it something that's right for you? And so we have some very special guests with us today to talk about that, as well as our moderator. And so I'd like to, first of all, to visit with you about what we are and who we are to put this on. This is actually hosted by the Uas Cluster Initiative. This is done through a program that's given to us through a contract through the Small Business Administration. We're actually one of 13 clusters in the nation, and our space, our sector is UAS, and our region is actually Oklahoma and South Kansas. But we do spread our wings across the nation, and we do that through a couple of ways. And we do some webinars like this one. We do some workshops, SBIR conference workshops we've done in the past. Here actually in the last couple of months. We do some roundtables and other networking events, and we also have our anchor event, the UAS Tech Forum, which is coming up in late August, which we'll talk about that maybe perhaps later on in broadcast. But first of all, I'd like to go ahead and introduce for you, let's get on with it, and I'd like to introduce you to our presenters and our moderator. First, our moderator is Phil Hurd. Mr. Moderator, Mr. Hurd, will you raise your hand? There you are. He is a portfolio manager for Cimarron Capital Partners, and it's a venture capital and equity funds, and he's very knowledgeable in this field, and he's been doing some fund investing for quite a long time. And one of our presenters is Mr. Carter Williams. Carter, why don't you let them know who you are? Okay, there's Carter. He is the managing director for iSelect Fund Management Group, LLC. And he's formerly was a director and founder of Boeing Ventures, where he led Boeing's technology planning process. So we're glad to have you here as one of our presenters, Carter. And last but not least, we have there also Carl Gimperly. Carl, there you go. He's a managing partner for Leadwood Venture Capital, and he's also founder and CEO of I hope I'm pronouncing this correctly, Carl, Alexis Corporation. Okay? That's right. All right, it's a market-leading innovator of industrial machine-to-machine communications, Internet of Things and technology solutions, and cloud-based data management systems. So, guys, thank you for being here for this wonderful event. And with that, I'm going to turn it over to you guys. And there's their lovely pictures on screen for you guys to look at as well. But if you don't remember who they are, that's who they are, and their titles underneath, and we'll get going with that. So our Phil Hurd, our moderator, go ahead and take over.
Okay, thanks, Harv, and welcome everyone. So we're focused today on the step where an entrepreneur is thinking about how to commercialize his or her product, and how to arrange for financing for that step. So this is part of the activity that's well within the footprint of a venture capitalist. And so in a way, we're really asking, what is a venture capitalist? How do they view the world? And can they be helpful to you? Near the end, we'll branch off and talk about UAS from the perspective of a VC as well. But the first part, maybe 3/4 of this, is all focused on generic venture capital. There must be 1,001 versions of venture capitalists out there. Actually, I was thinking about this, they're more like, in my world, 4,500 based on the size of our database. But today we're going to talk to 2 of them, and hoping they can give us some insights into this space and this activity. So with that, Carl and Carter, can you extend your introductions a little bit and tell us how you got involved in VC and fill us in about your firms? Carter?
You want me to go first? So I engineer by training in aerospace, originally McDonnell Douglas. Got more involved in technology development and did my graduate work at MIT, which got me closer to the startup world. Spent the back 2/3 of my career at Boeing investing in new technology, and more just got very involved in understanding early stage technology, its application to a particular market, and moved more and more into the venture capital world. Principally in my role to help look at a good opportunity and figure out, explain to my boss, the CTO at Boeing, hey, this is a worthwhile investment. And so that sort of evolved. I left Boeing in 2004 and became a founder of an early stage startup in the Internet of Things space. We grew successfully and sold to Johnson Controls. And then I circled back into the venture world, and since then I've been doing venture capital in a myriad of ways, and now with iSelect.
Tell us briefly about iSelect. What do you like to do there?
So iSelect is focused on sort of a capital gap. Most venture funds are set up and funded by pension funds and large institutionals. We noticed that in every place other than Silicon Valley, there are a lot of angels, but there are many more high net worth investors, and so we set up iSelect to sort of address high net worth investors that are on the sidelines that can't afford to invest in a venture capital fund. It normally costs about $5 million to invest in a venture capital fund, who had money but weren't ready to become an angel. So they wanted to invest in 20 startups but had no way to do the diligence and such. So we set up iSelect as a mechanism to invest everywhere but Silicon Valley and to draw in the large amount of high net worth individuals who really don't do any early stage investing but want to. Tend to focus on healthcare and agriculture, some IT, some national security related things. We tend to focus on industries that Silicon Valley is not paying attention to.
Great. Okay. Carl, fill us in.
Great. We've got some similarities and some differences, Carter. I'm also a tech guy. Started out in aeronautical engineering from MIT. I have a master's in manufacturing engineering, spent time in the aerospace and defense sector, but in 2000 launched a M2M wireless communications company, which merged and developed into an IoT and cloud-based software company. We listed on the NASDAQ in 2007, and then we were acquired by a larger public company in 2015. I stayed there for a while. Then I realized I really like growing technology companies and not working for a large company. So I'm relatively new to the VC business, but it's the best business if you want to get exposed to lots of young tech companies and help them get funding and help them grow. So that's how I got into VC. Our fund, based here in Kansas City, our investors are similarly high net worth individuals and small institutions. We do about 2/3 of our investments are co-investments. I'm on the investment committee of MIT's venture fund, so we co-invest along with MIT, Harvard, Yale, Dartmouth, and those investment funds, as well as my partner who has very strong connections on the West Coast. We co-invest with some of the Silicon Valley funds. But we reserve about 1/3 of our investments for regional opportunities, where we take more of a lead position on those. Typically focus, we're market agnostic, but we're not technology agnostic. We focus on technologies we understand. We've had the fund open now for about 6 months. 2 of our investments are in the AI space, 2 are software as a service. We've got an IoT and an energy investment. But really, we don't rule out any one sector. We're looking at a semiconductor materials company at the same time. So broad, we don't focus on seed. We focus on early stage to the early part of expansion stage.
Great. Excellent. Those are 2 beautiful bios. I hope to get to know you better soon. So let me move on. Venture capital has been around in a relatively big way for decades. And Carter, I'll start with you on this one. What is venture capital and why does it exist? And thank you, Harv, for putting up this prop. We may or may not need it, but it's good to have here.
Venture capital is typically equity capital, so it is money that is provided to help fund and grow a business until it reaches profitability. It is normally structured as equity rather than debt, so that just like you might buy stock in IBM, you can buy stock in the company. It breaks down in this chart in early stage, later stage, and also seed capital. As you get further off to the left here, these are much more risky endeavors. They are before they get revenue, before they get profitability, sometimes before anybody's even sure that the business plan makes sense. And what venture capitalists do is, rather than thinking about, hey, I just saw the perfect business plan and I'm going to invest it and I'm going to make a lot of money, venture capitalists typically review companies, take out what risk they can to be sure that the team is of a high quality, the business plan is reasonable, but then invest in 10, 20, 30 companies simultaneously with the idea that 2 or 3 out of those, that entire pool, are going to be big successes and return enough value that it makes up the investment in the winners and the losers.
Mm-hmm.
Carl, would you add anything to this?
Yeah, same. And really, it's, you know, for the entrepreneur on their perspective, venture capitalists trade off return for risk. So your valuation, as you de-risk an opportunity, the valuation can be supported at a higher level. If you're asking a venture capitalist to take investors' money in a specific investment, and it's very early stage, or haven't even proven market traction yet, they're going to expect a larger piece of the pie for success because they're taking more risk. If you're further along and you've been able to finance it with whether friends and family or angels, and you're further down the curve, then you'd expect a venture capitalist to be more reasonable in valuation because there's a lot less risk in the endeavor. So I think entrepreneurs need to remember that when they're looking for VC funding.
So risk is definitely part of the fabric of VC. You can lose investor capital. You can lose other things, I suppose, time, the chance to actually raise capital again. Can you mitigate risk? And how would you do that? Carl, do you want to take a shot at that?
Yeah, and there's a number of ways to mitigate risk. One, I use the Warren Buffett philosophy: don't invest in things you don't understand. So have a good understanding of the business. Even if it's pre-revenue, you still want to understand the market. The other things you can do when you work with entrepreneurs is ensure representation on the board of directors, have the ability to influence the direction of the business, and really to know the team and be comfortable with the team you're working with. To some extent in VC, you're betting on the jockey more than the horse, and you need to understand that business plans tend to change over time, and people in a management team need to be able to pivot, because in a lot of these tech fields, things change very, very quickly, and a business model that sounded great last year may change. So if you're working with a group and they're open to suggestions and changing direction, it gives you a better feeling of being able to mitigate some of the risk.
Carter, do you want to weigh in?
So every business will go through a near-death experience, so you certainly want to be sure that the team is of a quality that can sort of look at the situation, keep their minds, and push forward. That's actually, from a standpoint of picking the best companies, we're always going after markets that have some inherent novelty and risk to them that you can't control, and so you want, the jockey part is when you hit the divot, you want to make sure that he's the one guy that can sort of get on the other side and leave everybody else behind. The other thing we do to mitigate risk is, what does every startup need? A customer. You got a customer, you've got revenue. It may not be perfect revenue, but you get a signal about what the market wants. And in a lot of the areas that we're focused on, that market signal is critical. So one other thing we do is pay, in addition to paying attention to the quality of the team, is we work hard to sort of build out customer networks. This is sort of a derivative of invest in areas you know. So we've got very, very tight relationships across a wide array of customers in the verticals that we're addressing. And we sort of hand over that customer list to all the companies we invest in so that they can get those POs quicker, get the market information, and then adapt their product to grow to a larger revenue.
Yeah, if I can add, I think one situation that helps a lot is if there's a strategic investor on the investment team, a potential customer, or someone who knows the market, or even a potential acquirer down the road. that's also a great way to mitigate risk for a VC fund making an investment.
Hey, this is really what VCs do at the once you get away from all the glamour is we invest at X with the expectation of it going to Y. And part of that story when we invest, which is another risk mitigation, is we figure out who's going to buy the company at Y. Now, that could be an IPO, which is very unlikely.
It's very rare today.
Probabilistically, it's just unlikely to happen. Probabilistically, it's unlikely for it to turn into an Uber. But the guy who's going to buy at Y is important, so we pay a lot of attention to who that strategic might be. We actually talk to them and say to a Merck, hey, if we build this product over the next 3 years and the product gets to this quality of feature, is this the kind of company you would buy? And let's talk about that. And what risks would you be concerned about? And so then we go back in our investment criteria and make sure that at some level those risks will be mitigated through our investment. But at all times we're playing that sort of bid-ask between, we're putting money in now with the expectation that Merck or Monsanto or someone's going to buy it 3 years down the road. And in the end, that people may change, but the model helps us make sure that we've sort of addressed the risks that are unique to that market.
Yeah, I think entrepreneurs need to remember venture capital is not the same as private equity. Our investors are not interested in helping build a long-term family business and a lifestyle business for someone who wants to create a long-term company. We're looking for an exit, which may be owned by somebody else, and it becomes a large business. But VCs generally have a time frame on their investment, and they're always looking for what the exit is, even in the beginning when they're due diligencing an opportunity.
Harv, take us on to the next slide, would you please? And this suggests, as you look at this, time on the bottom, VC activity on the Y, suggests that there may be some good and bad times for finding venture capital. Carter, can you give us a few takeaways from this slide and tell us, where are we today?
Where are we today in the, well, there is a bit of a boom-bust horde mentality from a standpoint that investors, VCs raise money from institutional investors. That might be insurance companies or others. And so depending on where the capital markets are, there are pushing and shoving going on in terms of, hey, I got to get more money into venture, which means that more venture capitalists can get started. Conversely, you get these phases where people say, artificial intelligence is really hot. I can raise some money from pension funds. I'm going to go run around and go raise that money. So you get that. That's part of the boom bust. One of the things that's really made it worse is the concentration of all this resource in Silicon Valley means that it gets focused around a bit of a herdish mentality. So as recently people have said, hey, the amount of money going into venture, which I think probably is represented a little bit in the decline of the recent deal values, is, oh, we're not investing in venture as much. Well, I was talking to both Gates and Pritzker back in probably 15, and they were saying, look, we're just going to make fewer allocations to Silicon Valley because we think pretty much Silicon Valley is all topped up. There's really no more room to grow in Silicon Valley. So the boom-bust nature of this market often is driven by a bit of a sort of a herd mentality. I think something that will streamline it a little bit is as we invest outside Silicon Valley and other industries, the actual mechanism of venture capital is very effective to deal with risk. But applying it all in one place, as I say, creates a sort of ebb and flow. And some of the ways the deals are structured motivates this ebb and flow. Everybody's in Silicon Valley looking at IoT deals or something, and one guy does it, and then everybody else has to do it. And so you get sort of an odd sort of behavior that we seek to change by going to other industries outside Silicon Valley.
I hear you.
Overall,
that,
one other broad point I'll make is we generally believe there's about a $12 billion shortfall per year in early stage venture across the country. That sort of would be 1/4 of this quarterly if you look at how much they're investing. So there is more than enough opportunity elsewhere to deploy capital. There's good funding opportunities. The application of money is cheaper. So hiring a team in St. Louis or Kansas City or Oklahoma is cheaper. And they're smart people in those places too. It's not just reserved to San Jose.
And the other thing that hurts, sorry, along that same vein, I mean, you've got valuations on the coast are also crazy, and you can include Boston and New York in there. You get the herd mentality, everybody piles into a sector, and valuations get out of hand. You'll see there are some, we have activity in our market here where there's VC funds from the coasts who are looking for deals outside of the coastal area so you can get more compelling valuations, which is good news for regional entrepreneurs.
Yep.
Right, so I'm picking up that I need a regional data set. This one might misinform me if I were to rely on it for anything.
Yeah,
either of you
add some. Let me just add one bit of data here. New York, Silicon Valley, and Boston represent 70% of venture.
Right.
And so this data set, 70% of this data set,
it's all skewed by those three areas. Yeah.
The behavior in those three markets.
Mm-hmm.
I'm not sure you want to risk answering this, but where do either of you want to project where things are headed based on this curve?
It's hard. No, it's hard to project where things are going to go. That's a really small sample of data.
I believe that the nature of venture capital, everything that we've seen that works in Silicon Valley in terms of the application of early stage capital is going to move to every other major city in the country. And what we're going to see is 10 years from now, you're going to see other cities that are looking pretty much like Silicon Valley in terms of the ratio of that city's emphasis on venture versus later stage and public companies. I think that the Generation Z that's coming in just has a more natural understanding and expectation of, hey, if I'm going to start a business that sort of looks like this, and we'll see that the business of venture capital will move away from what I might call craft, we're specialists and only we know how to do it, to something more routine, where some of the fees will come down and the way to get into it will be simplified, and I just think we'll see a broadening of it. But it'll take about another 10 years. One point I'll add is St. Louis made a major effort to shift its venture activities in 2000, and we're just seeing that now. We're seeing the results of it where people say, hey, St. Louis is in the top 10 of emerging cities in that regard. And so you can sort of think that it takes about 12, 15 years for a shift where somebody says, our city's going to change in this way to occur, and I just don't think those numbers are in here yet, but they will show up.
Generation.
And I'll agree that the change there is not just on the entrepreneur's side of what types of companies that start. It's also on the high net worth individuals and institutions that if you go to Silicon Valley, it's natural for high net worth folks to have 5 to 10% of their portfolio in venture. If you do that in a Midwestern city, go to Des Moines or Kansas City or Oklahoma, the concept of venture capital is foreign to most investors who are more comfortable with real estate and other steady income producing investments. So you've got to get a transition not just on the startup community, but also in the funding community.
Yep.
Great. Listen, let's say I'm an entrepreneur and I'm thinking about commercialization of my product or service, and I'm wondering, is venture capital right for me? It seems, the more I'm hearing now, that it's pretty complicated. Carl, what are some of the elements I should include in my analysis? I'm not looking for an analysis, but What are some of those things I should pick up and include?
I mean, fundamentally, an entrepreneur has to be ready. When you give up ownership of your company, you're also giving up some control of the company. A venture capital group or firm will want some influence over the company. You need to understand there's a trade-off. Speed to market, especially in technology, is important. So starving for capital and hand to mouth, the launch will be slow enough. You might ensure that your company doesn't make it. Bringing capital in up front can help you accelerate and raise the probability of success, but with that comes the trade-off of giving up some ownership and some control. So you need to understand that that's going to come with it. No venture capital. VC firms are not angels who are going to give you some money and out of a philanthropic spirit. VCs are capitalists, and they're looking for something in return for the money and the risk they're taking.
Carter, do you want to?
Yeah, one quick way to back solve it is, venture capitalists are typically they're going to invest, and then someone's got to buy out their interest, and that typically means the companies can be bought, and most VCs are looking to see that occur at a valuation of $30, $40, $50 million or more, but really aren't going to invest in less. So to some degree, very few venture capitalists are going to pay attention to your interest of investment if you say, hey, I'm going to create this business, I'm going to get revenue, I'm going to get profitable, and I'm going to run it for 20, 30, 40 years and never sell out the interest. VCs are typically looking for a high return, so that they want to see that the company might grow year over year in valuation by 40, 50, 60%. So they're going to tend to focus on things that have intellectual property associated with them that are not necessarily services related. And then the other point is every investor has some variation, and the best investors say exactly what they do, and if you don't like that they don't do your thing, you're really not going to get anywhere telling them that. We try as hard as we can to say these are the kinds of deals we do, and these are the kinds of deals we don't do. And we do that so we don't waste entrepreneurs' time. There are lots of people that invest, and we do it because we really invest in areas that we know. And so if you're looking to venture capital, the things you should say are, first is, am I in this track for an exit? Second, is this firm on their website, they'll typically say what they want, what they're looking for, and don't fight it. They're just trying to be clear. And pick a venture capitalist that fits more of what you're trying to do. We don't operate well from a standpoint of, hey, if you send us 400 emails, somehow we'll sooner or later relent and all of a sudden invest.
We'll break down and send a check. No.
Right, we don't really do that.
Well, let's follow through here. So I've decided that venture is probably the right solution for me. I'm out there in the hunt for one. You've given us some clues about how to hunt them down. Are there other ideas, or have you witnessed an entrepreneur who did a particularly good job in their search?
Well, if I can jump in, yeah. I mean, a little bit to what Carter said. It's important to find a VC firm that's a good match for you, which means they need to be able to bring more to the table than just cash. Everyone needs cash, but they really need business expertise, a network, connections, and even domain and market expertise, so you can help the company succeed. The VC firm benefits from that, and so does the entrepreneur. So the key is finding someone who has a good alignment with you. Honestly, there needs to be good chemistry with you. I mean, no one wants to work with a group that they don't get along with. So having the same philosophy of business and the same understanding of the goal, you share that, and that's really important to your decision on the VC. If you look for money, I mean, it's hard to raise funds, but raising funds from the wrong group, you're better off not doing that and waiting and finding a group that's going to help your business grow.
The basics on a company that we like to see is, here's our elevator pitch. Very basically, this is our story. These are the milestones. There are risks in this business. These are the risks. We're asking to raise $2 million to reduce these risks to get to this next milestone. after we get through these 2 or 3 milestones, we're at a point where this company may be interested in buying us. So you sort of want to see a rough sort of logical sort of stepwise progression with a respect that sort of says, we think it's going to cost 3 to get there, but it may take $1 million, and these are the reasons why. And so if you can sort of represent where you think the risks in the business are, we're risk reduction capital in that regard for known risks. The last part is that on our team, I sit in every single first meeting because I learned something in every meeting. We invest in 2.5% of the deals that we do. The diligence team digs through everything else, and often I don't see the companies again for a little bit in a senior role. But it's really important to me that I learn something new in that meeting. So
what do you mean something new?
I've had the opportunity to see a lot of different things over many, many years, and so it's this is going to sound a teeny bit arrogant, but you're not going to tell me something that I haven't probably seen in one form or the other. If you are, maybe it's a little bit too far out there. But what I do like to hear is a new insight. So, like, we've been looking a lot at stroke, and a lot of drugs around stroke, and we had one that came in that had an antidote to TPA, and they were able to explain why that would solve a whole bunch of other problems in the stroke market that nobody's been able to deal with. And so I learned this is a market that we want to figure out a way to get into. We couldn't figure out a way to, but when they said the big resistance is how do you get it approved, because nobody's approved anything in stroke for a long time, but they said the FDA wants to get an antidote to TPA in place because it'll help other parts of treating patients. And we were sitting there, I was like, Jesus, why didn't we think of that before? And so for our team, it was a big insight into the market. And so that's an example of something we learned something new that we hadn't known before. If we don't learn something new on a deal, it's sort of boring. We pay attention to our deep.
So what tends to be a standout observation for you, Carl? You're looking at new companies.
It's similar. What you don't want, VCs particularly, I don't want to invest in it. Me too. Hey, there's 3 other companies doing this, and we're going to be slightly more efficient at it, and we think we can displace them in the market with better customer service or something that's non-disruptive. So, I mean, similar to what Carter said, I mean, whether it's learn something new or appreciate a perspective that's different, a different approach to solving a problem that's wide. But it needs to be a big enough problem to matter. We've had pitches from folks that they're going to revolutionize a market that's tiny today and might get a tiny bit larger. That's not worth the risk for a VC. If it's a market that's potentially huge and you're going to disrupt that market, then it's a lot more attractive.
I'll tell you what, let's pick up the topic of drones and the UAS industry. From the VC's perspective, what is notable about this sector? What's good about it? What's bad? What are the pitfalls? Oral.
Well, I mean, it's a hot sector. Everyone's talking about it. A lot of excitement in the sector. A lot of pitches we see in this area are service-type industries, which frankly to most venture capital firms are not that interesting because they're not as scalable. If you are going to double your revenue and you need twice as many drones and twice as many operators and your revenue is going to be twice as large, that's not a scalable solution for a VC. We typically focus on disruptive, whether it's technology or analytics software that can truly add value to a market. So that's exciting. One of the pitfalls is the uncertainty in the regulatory market. And the fact that you've got multiple parallel solutions in process, and very much like pharma, one of those solutions may become the standard and the other ones are going to be gone. And so it's a little bit of a hit or miss gamble right now in some of the approaches to, for example, detect and avoid and such, and conforming with some of the FAA requirements that are still in flux. So there's a regulatory risk and there's the it's a new market risk, and no one's really quite sure how the economics are going to work out in some of those areas.
Does that tend to be the case? I'm looking at this list right now. Are there some of these that are a little more promising at this stage in development? I'm looking, of course, we have platforms. We have everything that you might add to a platform and the services downstream. Are some of these subsectors more appealing at the moment?
Yeah, you know, from our perspective anyway, on the technology, it's the sensors and the systems that you would put on every platform if they satisfied a regulatory requirement were adopted. If it's a company that's going to manufacture yet another model drone that's a small improvement over the last generation, that doesn't have the explosive, disruptive growth curve that you would expect. The other piece is who would acquire the company. You may have, you know, Amazon's very active in the space, and do you come up with a technology that somebody wants to control? That's more attractive to us as well. Carter?
I'd say anything that's more industrial applications feels like it's more important. Businesses that reduce the costs of other businesses, so, or enhance the quality of services. So utilities, there's big markets and utilities and industrial, Amazon, that are all, and logistics that are all trying to sort of streamline processes. So those always are sort of appealing. I'm intrigued very much about people that can demonstrate a new regime for the regulators that can help set regulatory policy, that their product is so compelling that the demand from user adoption will sort of lead the way in disrupting the regulatory frameworks, but do it in a polite way so they can sort of operate under existing frameworks but also provide new guidance. Generally, the area of mission systems, so how do I plan out all of my UAS activity and integrate it into my enterprise systems? That layer is really intriguing to us. And then on the sensors, it's a lot about getting the cost and price down and power demand down. Those are very interesting. We like public sector, logistics, agriculture, inspection broadly. We do a lot of work with National Geospatial Agency, and so in terms of sensor platforms, to some degree, we sort of flip back and forth in terms of our thinking about whether it's on a UAS or whether it's on a bigger platform that's satellite-based. So the fusion of that data is becoming much more important, and the UAS is just a node on the platform.
Great. Okay, let's see if we have any questions so far.
Well, we're looking here at the chat. Sorry, it took a delay there to get to those questions. We have one question that says, they ask, as a company, how do you decide how much equity to give up for an investment? As a company, how do you decide how much equity to give up for an investment?
You want to?
Sure. I mean, naturally, you want to give up as little as possible for as much cash as you can get, right? That's the simple answer. I mean, really, typically an entrepreneur, I'll put the entrepreneur hat on here, you want to retain control over the business if possible, and you don't want to dilute too much. You want to make sure you keep enough in reserve for incentives for your own employees as the company grows, and to keep enough in reserve for follow-on rounds. So typically, you don't want to get excited on the front end, take a cash infusion in exchange for too much equity, and then if you need more cash later, you end up diluting yourself. So after you've done 10 years of work, you end up not owning very much of the company. So that's as an advice to an entrepreneur. You want to be somewhat cautious about how much you give out. Different companies that have done convertible debt to try to avoid equity. There's a number of ways to do that, but there's really no one formula of how much you should ask for per dollar, let's say. other than be cautious, because a lot of people think, I hate to borrow money and pay interest because it's expensive, and they think of equity as free, and they get cash and all they have to do is give out equity. But in the long run, on a successful company, giving out equity is the most expensive thing you can do.
So the market sort of settles a bit of these numbers, and so I'd say the best companies we've invested in on a seed stage, that they tend not to sell off more than 30 to 40% of fully diluted basis of stock. On a Series A, they tend not to sell off more than 20 to 30%. And the key thing is always be sure your investor's willing to keep 20% of the fully diluted stock available for employee and founder incentive, and that they're willing to gross that up. So in each round that they're willing to refuel that pool of capital. If they're not, if someone's coming in and say, I want to buy 50%, or no, I'm not going to give out those options, then I think they're not really venture capitalists. A venture capitalist is buying into, hey, I'm trying to get a good team here and properly make sure that the entrepreneurs are going to make more money than me, in a sense, in terms of their time and commitment, because I want them working 24 hours a day trying to figure out how to get to the marketplace. One thing we often find is that people immediately go to equity, and we had a couple deals recently where like half of the raise was really for working capital, and that could be covered through revenue. It was more revenue based, and they're like, well, we think we want equity. And it's like, why do you want equity? Let's protect the cap table. So I think it's everyone's sort of on the equity bandwagon a little too much. Sometimes your finance team should think a little bit harder as to whether some of that could be done as debt through through a few other mechanisms.
A working line or something, yeah.
But we're not going to offer debt other than something that's convertible on our terms. So a couple things you should do. But generally, if someone's saying they want to keep 50% of the company, it's going to turn out bad. if the investor wants more than 50%, it's going to turn out bad.
Hey, another viewer once asked, and if you've already covered this, guys, forgive me, but he says, how did you determine what kind of industries or verticals in which you would invest? I guess he's referring to your specific funding history.
We are multi-sector. It is important that we know the industry when we build that out through a network of advisors that we have, but we further will only invest in an industry where we have proximity, where that startup has proximity to its customers. So we do a lot of agriculture in St. Louis because we have Monsanto and a whole bunch of ag networks right here. Kansas City, we would do animal health. Memphis, we would do logistics. So in addition to where our domain expertise is, we alter depending on the company and its immediate proximate location that it's going to be able to get the customers without any challenge.
And that's similar with us. I mean, it's not so much geographic for us. It's in the two different types of investments we make. If we're co-investing, we need to co-invest with a team that has expertise and can take the lead on managing the company or having input to the company management. For the ones that we lead, the third of the investments we make, having an understanding of the technology and understanding the pitfalls and the advantages and the opportunities to disrupt certain markets. We need to understand the market. We need to understand the technology.
Well, as investors, I'm sure that you come across a lot of different types of individuals who are looking for some, with investments with entrepreneurs and others, and there are probably some challenges I would assume that you guys face when you're dealing with entrepreneurs to make those deals. Can you kind of talk about some of those challenges that you face when you do come face to face with those individuals, or some of those deals that maybe they're trying to get from you, and there's kind of a give and take situation going on?
I'd say probably the most frequent friction point is valuation and control. with entrepreneurs. So some entrepreneurs have put so much of their heart and soul into it. They believe in this, and it's a, you look at their projections, and it's a sure thing, $1 billion. I can't believe you wouldn't put this money in now because we're all going to be filthy rich. It's going to take no effort, and we'll be there tomorrow. And trying to get them to understand the risks. I mean, they've put so much of their own heart and soul into it. Sometimes they don't take a step back and look at it from a business perspective or a risk mitigation perspective. So that's typically the times we've had it where the investment seemed good, the market seemed good, the technology seemed good, but we couldn't get to an agreement, is typically over those issues.
Carter, what kind of things did you face?
If I run into someone who's disagreeable, we tend to wash out of that pretty soon. We operate in a market, if we were in Silicon Valley where there was more competition, I suppose we would get a little bit more aggressive. But generally, I'd say our best companies are pretty reasonable and come in with low valuation expectations. Whenever we've had a deal come in with a high valuation, we normally find 10 other things wrong with it. Where it comes in with is just insanely high valuation, or they're gaming us up front and sort of saying, well, I think the valuation is 50 million. And it's like, there's nothing to justify that. It's probably 30. It's like, well, I'm willing to negotiate. That's pretty much the end of our conversation. If you're overbidding into the conversation, it just shows a lack of maturity.
Do you think that some people, Carter, you look at like Shark Tank, for instance. People are very aware of that show. Lots of viewers to that show. And lots of times they have these higher valuations of their companies than what the sharks themselves say the company is worth. Do you think that some people who are novices in this particular arena go into it thinking like they're trying to sell a house or buy a house, where they're saying, well, let's put the price way up there, and then we'll start from there and then work our way down, or vice versa?
Yeah, I think it's a fundamental thing. The valuation is, we look at what we think the exit will be, and we're going to check it, and that's where we specialize in understanding that, and we build that range, and then we back solve for how much return we have to get, and that nets out the most that we're willing to pay. Mm-hmm. So it's like a guy doing a rehab in a house. I'm going to buy a house. I think I can sell it for $300,000. It needs a new kitchen. It needs a new bath. It's going to cost me $50,000 to do, and I can buy the house for $100,000. So we sort of back solve the process a bit, and so that's how the math is done. But we like to work with people we like, and we're also working on things that are hard, therapeutics and agriculture. So we want to be able to get along with the team, and if someone's just coming in blustering, we just don't do it. It's
a non-starter.
The other thing we do, I'd say the thing that we've probably run into trouble is sole entrepreneurs. It's important that there are two founders that are different than each other, one market, one technology, that they've met through business, not personal, so that they're not brothers, or they're, that they were best friends in college. But so a couple things like that we do to just make sure that there's some diversity in the thinking of the team.
Okay. All right, we also have another question here. This may be our final question before we move on. It says, what is the best way to connect with VCs? Obviously, this webinar is helping to do that to some degree, but really, what is the best way for those that are looking for deals and looking for funding, especially from the VC arena? How do they get in touch with you guys? How do they go around that web, that labyrinth, if you will, out there of all these different capital firms and corporations and businesses?
I mean, the most effective would be a personal introduction from either a company that we've worked with, or a company we know, or investors that we know. That's the most effective way to get our attention. We get pitches daily on the website, and frankly, those get a very quick look over. We attend events and such, but really, if you can get our attention, you have a better shot at us doing a full review of the opportunity. That being said, it doesn't mean you're going to go anywhere, but having a connection in the community, getting to know your local economic development council, whatever ecosystem is present in your region, getting to know those people and being connected, whether it's Kauffman Foundation or one of the development programs, they typically have a pipeline, so to speak, between budding entrepreneurs and potential funding sources. And being referred through something like that is more effective than just a blind email or a blind, tossing a pitch into a web box.
Referrals matter, and the reason why referrals matter is I thought about building an app. Carter is 5 days behind on reading his email. I get so much email from so many different groups of people, and I need to try to discern whether I should pay attention to it. And there's just an information overflow part to our process that I feel bad about it, but I can't stop people from emailing me. So I mean, I want them to email me and as a contact, but sometimes it's hard for us to pay attention to say, oh, that's what you're talking about. And so the referral helps sort of knock things to the top of the table if somebody says, oh yeah, these guys are working on this. This is what's novel about what they're doing. Even short notes, if you are gay, at least in my case, if you send something and you study us enough and sort of can say, look, we're doing this, but what's novel about what we're doing is X, and you can sort of communicate that, then it just helps me process a lot better as to whether I want to pay attention to what you're doing. I don't really need to know how smart you are, or we'll figure all that stuff out over time. And you don't need to play sales tactics with me. Just tell me what you're doing in a novel, make it short and sweet, and don't get offended if I give you to our diligence team to dig into it.
Phil, even though you're serving as moderator for this particular event, this webinar, you have past experience in the capital VC industry. How do you see, what do you think is some of the best ways that they can connect with VCs?
Well, I just wanted to follow through on these last couple of points about the importance of the pre-VC network. So spending time to build that up, get known, find people who might lead you in the right direction or make that connection for you. So it doesn't hurt, and you don't know. Down the road, that very contact you made may serve you. So it doesn't hurt to keep working on that network and build it out continuously. And the other thing I was hearing was differentiate. I guess that can happen in many ways, so be creative.
Okay.
That's what I'd say.
Okay. There's also, actually, another question came in. Maybe we can answer this in about a minute or so. We're coming down to the last part of our webinar. It says, how does the nature of an industry segment affect the way you do a deal, i.e. biotech versus IT or others? How does the nature of an industry segment affect the way you do a deal, biotech versus IT or others? Anyone take a stab at that?
We have different criteria. So in biotech, it's much more, biotech, biologics have a 1 in 13 chance reading commercial. New molecular entities are 1 in 27. Drugs that go through the eye have a 1 in 7 chance. So we've got a whole network of those kind of questions that in the biotech sector are very specific about probabilities of success, and then are very stage specific and have very disciplined things. Software, so we'll do biotech, but it's got to have a target, pre-IND, biologic, not new molecular entity. If we're talking something like IT, we want to see revenue. And if we're doing ag, it varies a little bit. So we will change what the criteria are a bit depending on sector. And in our case, it's really derivative of what's the probability of success in that marketplace from sort of analytics that are going on that.
And all I would add to that is all those same factors, probability of success, but also potential size and growth rate of that market also factors into that, the willingness to look at it.
Okay.
Thank you, Harv.
All right. Well, we're about out of time. We have about 2 minutes left, so I want to let people know that are listening or watching this broadcast, that there are some resources that they can use to help them see if VC venture capital is right for them. These are some things that that our moderator Phil Hurd graciously provided for us. That these links here that you can use to go to these particular websites and look for information that'd be helpful for you. So thank you, gentlemen, for serving with us today.
Great. Thank you.